Hello, everyone, and welcome to another edition of the More Than Markets series. My name is John Bay, Senior Vice President and Chief Investment Officer of NEI Investments and Aviso Wealth. On this call, I would like to address the recent market volatility driven by the U.S. inflation reading and the recent Federal Reserve interest rate decision. So let's get started. I'd like to start off by saying that for us, the investment landscape has significantly shifted over the past week. Really started with that inflation reading on Friday, June the 10th. Really before the reading, the markets were pricing in a Goldilocks scenario where the Fed had well telegraphed that they would be increasing interest rates by 50 basis points in the June and July meeting and ending by about 3% by year end. And the reason why that 3% is really important for us is that that is the top end of the so-called neutral interest rate range. And by neutral, what we mean is that interest rates at the policy level were not restrictive to the economy or stimulative to the economy. It was just very neutral. And so really at 3%, it's top end of the neutral range, what we're saying is that interest rates would be high enough to get inflation down to the 3 to 2% range, but really not too high or high enough to push the economy into recession and push the job economy down even lower. And so that was the soft landing that people talk about a lot. But now with that inflation print on Friday, June 10th, but also importantly, there was a second data that came in that comprised a double whammy. That was that consumer expectations continue to increase. And what I mean by their expectations is expectations of higher inflation. Their inflation expectations rose to 6.6%, which was, again, tied for the highest expectation on record. And that's really important for the Federal Reserve because what they really wanted to see is that inflation expectation for the consumer, even though it's high now, that they expected it to remain well anchored in the 2%, and it was not drifting lower, it was actually going higher. And so the markets really reacted swiftly to those two inflation data points on Friday by saying that the Federal Reserve really needed to be much more aggressive in their interest rate hikes. And they immediately priced in not a 50 basis point move, but a 75 basis point move on that Wednesday meeting. And that they would have to take up interest rates to not 3%, but to 4% by year end. And so really the Federal Reserve actually did take that window of opportunity. They did move by 75 basis points. But importantly for me, in their statement, they took out a really important line. In the previous month, they had a line that they expected inflation to return to the 2% level and the labor market to remain strong. By taking out that line in this month's rate decision, basically they're saying to the markets that they were prepared and singularly focused on inflation. And even if they had to weaken the labor markets and push the economy into a recession, that were prepared to do so. And so what that meant was that Goldilocks was off the table. And so with that news, recession became a top concern for investors. Stocks sold off and bonds sold off as they began to price in higher interest rates. And so, typically, what does this mean for both bonds and stocks? Well, recession clearly is not good for stocks under that scenario. The typical drawdown in the markets in a recession is 33%, and the typical drawdown in non-recessionary environments is 20%. And for bonds, they typically do well in a recessionary scenario. But again, for importantly, we still don't know if inflation has peaked, and if inflation hasn't peaked, and it's deemed that the Federal Reserve and the Bank of Canada will need to take interest rates higher than 4%, you may see bond yields continue to climb, and that would be negative for bonds. And so, what are we looking for in terms of whether or not inflation has peaked? One of the things that we'll be looking at is oil prices. Oil prices are clearly correlated to long-term inflation expectations. And if we see that roll over, that will be a good sign. Right now, oil is very sticky in that $100 to $125 a barrel. And if that were to again, trade below $100 a barrel on a sustained basis, that would be really good. A sign that inflation pressures are peaking, and that would be confirmed in future declines in the monthly inflation prints. And so what are we doing? Again, with this new language, we've made no changes to our strategic asset allocation, these portfolios with longer term time horizons, but on a tactical basis for our portfolios that are able to take shorter term considerations into consideration. We've slightly reduced equities. We haven't reduced that, but we have slightly reduced equities, and just to be a little bit more defensive in the near term. However, our long-term perspective on this is that we historically we would acknowledge here first and foremost that it's a very difficult time for investors with both stocks and bonds trading off significantly. It's super tempting to sell while the markets are down. But historically, it is very difficult to time the markets. Not only do you have to get the timing when you sell equities right, you also have to get the timing on when to get back into the stock market as well. And historically, it's very, very difficult. So if you look back at other extreme events of the global financial crisis, the March 2020, the dot-com boom, these were very, very difficult times, and we just didn't know if the economy would recover from these events and how long it would take. During those times, historically, it's proven to be a very, very good time to be invested and to stay invested during those deep drawdowns. And so with that, we do want to thank you for tuning in. We hope that you found today's discussion helpful. Please watch out for our next More Than Market call. And as always, please reach out to your NEI representative with any questions that you may have. Thank you so much for tuning in, and stay safe.